Hi there, welcome to Kneppy Invest. I'm going to do another technical update. But before we look at some charts, I'm going to go through a few interesting tweets that I did see during the week. The first tweet here has nothing to do with investing, but in my opinion, this tweet says a lot and really resonated with me. This is from a guy called Sahil Bloom. I have no idea why this tweet came onto my Twitter feed, but again, it resonated with me. And this is something I do every single day. Not a 15-minute walk. In fact, I go for at least a 2-hour walk or run every single day without fail, even when I have, or in between two night shifts. I actually do go for a walk in between two night shifts. And when I'm talking about night shifts, I'm talking about 12-hour night shifts. And this guy mentions the sunlight and movement have a positive impact on your mood, circadian rhythm, metabolism, and digestion. And as a shift worker, I have found that regularly exercising has worked wonders. I have no trouble sleeping. And I think that has a lot to do with very little stress in my life as well. And one of the reasons I have very little stress is because I'm fairly financially well off right now because I have invested wisely over the past 15 years or so. So if you do find a little bit of stress in your life, if you do think everything's overwhelming, just going for a walk, a simple 15-minute walk, as this guy suggests, can do wonders. So now on to some of the other interesting tweets that I did see during the week. The first one here is sort of an indication of who's been doing all the heavy lifting. I've already mentioned this in quite a few of my technical analysis or even weekly updates, daily update videos, is that the most of the heavy lifting, if not all the heavy lifting on the NASDAQ, is being done by a few select companies. And these are the biggest companies in the world: Meta, Amazon, Apple, Microsoft, Google, which is Alphabet now, Tesla, and Nvidia. Those seven companies are up 53%. This tweet is from Jesse Cohen. 53% from the start of the year or December of last year. Meanwhile, the S&P 500 is up 11%, which means the remaining 493 companies on the S&P 500 have gone nowhere, flat. So that just shows you that the only reason the S&P 500 is up 11% is because of those 7 big tech companies. And this is also a reason why the Australian market is also flat during the past 7 or so months. And we'll have a look at the XJO when we look at the charts. So a nice tweet, interesting tweet from Jesse Cohen. The next one is from Michael Stubavaski. I don't know this guy. This was just a tweet about NVIDIA, how the shares today cost 40 times historical annual revenue. That's 40 years to get your money back, assuming zero cost, zero tax, and 100% payout ratio. Good luck. So that's price to sales ratio. Now, the most interesting thing about this tweet was just the replies, because I just wanted someone to mention that this price to sales ratio is not counting in any significant growth in the future. And the market, I think, is expecting significant growth when it comes to NVIDIA, and that's why the market is willing to pay 40 times sales right now. And fortunately, the first reply was all about that. Why does everybody use historical revenues with a very cyclical stock that just emerged from its downgrade or down cycle phase is beyond me? It's expensive, no argument there, but we should use appropriate metrics. As someone else mentioned here, call me crazy, but investors might expect them to grow earnings over 4 decades. And that's exactly what the market is expecting. NVIDIA to grow phenomenally, maybe not over the next 4 decades, but definitely over the next decade. So I just love Twitter. It's just full of really interesting information. This is from Bloomberg Markets from 2020, October 11, 2020. For some reason, this got a lot of attention during the week. The Fed is determined to push inflation higher from levels it considers dangerously low. For that to happen, it must first convince everyone that prices will accelerate in coming years. So they've done their job, maybe a little bit too well. Some interesting replies from October 11, 2020. And then we did get some replies in the last week or so, somewhere here. A bit further down, probably. A lot of replies, anyway. Anyway, so that's from Bloomberg Markets. Next one here is in regards to the Sharpe ratio. I'm not a big expert on the Sharpe ratio. It has to do with the risk-adjusted performance of an asset category like stocks, and this is compared to, say, like a benchmark, and what you want is above 1. So if that stock class has a Sharpe ratio above 1, that means it's performing better than the benchmark. So there has only been 4 times in history that the US stocks have a rolling 10-year Sharpe ratio greater than 1, the Roaring 20s. And what happened after the Roaring 20s? We all know the Nifty 50s. And then we went into a period in the 1970s of pretty high inflation and stock market bouncing around. Internet bubble, the late 2010s, early 2020s, COVID, meme stock, shit-oing era in the misspelling there. Anyway, so that's suggesting that maybe we're in an area where the market or the stock market has outperformed, and we need some sort of a reversion to the mean. That's probably what it's saying. We need a reversion to mean in a period of time when the stock market underperforms. And I have been thinking about that over the past 3.5 years. In fact, I started this thinking way back in late 2019, early 2020. And that's one of the reasons I decided to sell a lot of my shares and pay down my mortgage all the way down to zero, was just because I thought the market was going to underperform a lot of the benchmarks over the next 5 to 10 years. And I think that is still on the cards. That doesn't mean it's going to happen, but it's still on the cards. I did Google Sharpe ratio because I just wanted to completely understand it. I still don't completely understand it, but I do have a little bit of better understanding. This is an interesting one from Michael A. something or other. I won't try to pronounce his last name. And this is looking at the copper-gold ratio and how that compares to the 10-year Treasury yield. And there should be a fairly good correlation between those two. And there has been since 2009, a really good correlation between the 10-year Treasury yield and the copper-gold ratio until 2023. And we have seen a sort of a disconnect between the two. This guy mentions, has it lost its importance, or will there be a catch-up? Maybe that's from Morgan Stanley, not from Michael A. Arrowroot. But that's something else is that interesting, that there does seem to be that disconnect. And we're seeing a lot of disconnects in a lot of these sort of metrics right now. And what's going on with the world? Who knows? Crazy times. I also heard someone mention yesterday, why is there being so much attention to this not submarine, whatever it was that exploded, the Titanic thing, while there was a boat capsizing off Greece that killed 500 people? And my simple explanation behind it was, we have seen a lot of boats capsize and a lot of people lost over the past 5 to 10 years. It happens all the time, but this thing that just exploded or imploded hasn't happened all that often. In fact, maybe this is the first time. So because it's so unique, that's why it's in the news. It's not necessarily because it's rich people who died. It's just something that's unique. And if you remember about 5 years ago, 7 years ago, whatever it was, when that boat capsized and that young boy was taken out of the water, a lot of photos, that was in the news because that was unique back then. But since then, it's become an all too common situation when a boat capsizes, bringing refugees from Africa, those sort of places, and that's why it doesn't make the news anymore, particularly compared to this thing imploding, which is interesting. Anyway, that's just my thoughts on that. Jurian Timmer, my bull go-to person, Twitterer, broadening segment of the market, not just the mega caps, is starting to warm up. The percentage of new highs versus new lows is 17%. That doesn't seem like much, but the scatter plot below shows that this is in line with historical precedent. So this is talking about breadth and saying, well, where we probably should be, new companies making new highs versus new lows, we're exactly where we should be. So what's happening in the market right now is not unusual when you look at history since 1928. I do like people who are reasonable, who, although he might be a little bit too bullish, but yeah, he gives a good counterbalance to all the bears out there. I tend to be more of a bull than a bear, in the overall scheme of things. So I tend to focus on the bears because I want my views to be challenged. That's what I want. And that goes through is truth or true in all things in life. I want my views to be challenged all the time. For instance, I'm absolutely believe in climate change. I think that's without doubt. The proof is there. And I have read things that try to challenge that. And anytime I read anything that tries to challenge climate change, it's completely nonsense. Absolute nonsense. Anyway, let's go to this one. Sort of was one of the reasons why we did see a couple of down days on the US markets, that Powell mentioned that the interest rate pause is expected to be temporary. I'm not certain about that. History shows us when the Fed does decide to pause, particularly for a longer period of time. So if they continue to pause for a longer period of time, more than likely that's it. So if we do see them continue to rate or increase rates in the next few months, that's a very temporary pause. But the longer they keep it paused, the longer it's going to, more chances but this is the height in interest rates in America. A nice photo too of Powell there. Anyway, UK inflation came in higher than expected, 7.1%, forecast 6.8%. So there's still inflation out there, and it's not good when inflation comes in higher than expected. What we want right now is inflation to be coming in lower than expected. That's what we want. Then the next two tweets are on Japan. Now, Japan core inflation, we are talking about a 40-year high. Core inflation, so excluding fresh food and energy costs, came in higher than expected, 4.3%. 42-year high, massive increase in inflation. And the last time it was this high, 42 years ago, makes sense. So that's 1980 or something. So, and not only that, and one of the effects of this higher than inflation and expected inflation was the Nikkei 225 down 2.6%. I was wondering why the Australian market was down a fair bit on Friday when the American markets weren't down much. And I think one of the reasons why the Australian markets took a tumble was because of what happened with Japan. And the main reason Japan markets took a tumble was because of inflation. And to be honest with you, I didn't have a close look at this, but that was one of the tweets that did pop, or these tweets popped up on my Twitter feed late on Friday when I went through my tweet deck, whatever you want to call it. I have no idea what you call it. Now let's have a look at the charts. First one here is the XJO. I did have a look at the XJO during my weekly wrap-up, the daily one. So let's have a look at the weekly. And to be fair with you, when you look at the weekly chart for the XJO, nothing to be concerned here at all. It's in the middle of the trading range, a long-term trading range since the GFC, right in the middle of that, which means it could go higher, it could go lower from here. Interesting enough, so during the past week, I've listened to quite a few, like Osby's The Core and all those sort of podcasts-like things, and definitely the sentiment was more bullish because we did have quite a few up days. But when you look at the weekly chart, we've had 7 down weeks out of the last 10. So the market actually is down a fair bit since January, when it almost got to 7,600. Right now we're at 7,100. So it is down a fair bit since the start of the year. So even though we did have a really good week last week, just because it's one good week doesn't mean that's a change in the trend, doesn't mean it's changing the sentiment, unlike a lot of the people were sort of trying to say on these podcasts and such. And yeah, so on there, the bearish nor bullish when it comes to the XJO. Overall, when you look at the long-term trend, it's bullish because it's going up. So in 5 years, more than likely, the XJO will be higher than it is now, unless we have a significant... even then, I think even no matter what happens in between now and 2028, if we have a massive recession, I still think it's going to be higher than it is now, because it's not like, if you go back to just before the GFC, look at that massive bull run, huge bull run from about 2003 all the way to 2008. And then we had the correction, and it took a long time till we beat those highs back in 2007 or wherever it was. So we haven't really had that bull run yet. So we've just been meandering up slowly since 2008, 2009. So we haven't had that bull run to suggest we are overvalued, in my opinion. It's just my opinion. I could be wrong. Unlike the NASDAQ, which is still in a beautiful uptrend, no end in sight. So even though we had a couple of big down days, you don't really see that on the NASDAQ. But not the same with the Dow Jones. In fact, on the Monday, the Dow Jones did try to get through a resistance level. No, that was on the Friday. Oh, that's right. They had a day off, Juneteenth, whatever it's called, 19th of June. On last Friday, it tried to get above this resistance level. It failed. And it's tried to get above this level 1, 2, 3, 4 times in the past 7, 8 months. And after that failed break, we have seen it pull back a little bit. So just like the XJO, the Dow Jones just going sideways. And this goes back to that breadth. All the heavy lifting on the markets are being done on the NASDAQ and being done by those 7 companies. And fortunately, I own, is it 5 of those companies? I think 5, yeah. Bitcoin. I think there was one tweet I was going to show you that I didn't show you. I think it has to do with the Bitcoin. It could have been an explanation why we saw a massive rally in Bitcoin over the past week or so. But it came off support. In fact, I'll just show you this. I think if you look at this, so this is showing you the short-term trend and long-term trend. So what I usually look is just one trend here, which is a combination of the two. But another thing I sometimes do look at is a sort of combination of the long-term trend and the short-term trend. And the Bitcoin did bounce off the long-term trend, which has turned upwards. So the short-term trend was down. It came or bounced off the long-term trend fairly violently in the past week. And we have to draw a line, go to the old high. Now, this is, when I draw a line, don't think of it as a line, as a one price point. Think of it as a net zone. I haven't learned how to draw a zone in trading view. So my zone would be sort of around here, up a little bit below, above that line and below that line. And right now, Bitcoin is hovering and has been hovering around that zone for the last 3 days, which means there is a bit of supply when it comes to Bitcoin at these levels, because the most recent high back in April was at these levels. So there were some people who bought in Bitcoin in April, saw Bitcoin go down and thought, oh, this is a dog cryptocurrency. I was going to say dog stock. This is a dog cryptocurrency. Why did I buy this? And are selling now because the cryptocurrency has bounced back to the levels they bought in. And I have heard this time and time again. In fact, I heard this from 2 colleagues. The only 2 colleagues I know who invest at work both said this. They bought into stocks at the time. The share price of those stocks fell. I said, well, what are you going to do? And they said, as soon as the share price of this stock gets back up to where I bought, I'm going to sell. Yeah, this is further proof that technical analysis works. Further proof. Anyway, that's all I really have for the markets and Bitcoin. I might show you some gold stocks, but let's have a look at some companies. Company I'm really interested in is Vitura. This is a marijuana company. I think they own, I forget what they do. But this company is profitable. Not only are they profitable, they're a dividend-paying company, a dividend yield of 2.1%, a pretty good revenue, $67 million of revenue, $6 million of profit, nice profit margins, 9%. Share price, and you can see it really hyped up back in the late 2022. Share price went from 19 cents all the way up to $1. And then for some reason, I'm not sure why, share price just dropped all the way from $1 down to 31 cents. But possibly, I'll go back to my preferred. And possibly, so what I'm showing you here is, what I've got here is 3 moving averages. The 25, 75, and 150. So the 150 line, which is the solid blue line, is my long-term trend. Some people might use 200. I just like 150. And the other one is sort of a combination of a short to medium-term trend. And what's happened with Vitura over the past few days, 4 days, is we have seen a break of the Vitura share price above this little resistance line, which was the hold highs. So we now have moved to a new high. And that was tested, that resistance level. You can see it tested on the 2nd and 3rd of June. Share price went to that previous high and then didn't really pull back all that much. And then on the 20th of June, and I don't think there was any news, share price of this company increased 19% on fairly nice volume on the day. And this is the sort of strength I want to see. Preferably, I like to see this sort of movement on some really good financial news. But more importantly, what's happened in the next 3 trading days, the share price went sideways, including those 2 days where the overall market was down a lot. share price of Vitura went sideways. This is telling me there's not a lot of supply right now. And if we see a little bit of ramp up in demand, we might see the share price take off from here. So a possible breakout for Vitura, a possible movement into a new uptrend for this company. And if we do see a positive update from the company in the next week, that should open some eyes that there was someone out there who was privy to this information. And that's why we saw that really good update on the Tuesday, the 20th of June. Another company that did really well the last 2 days when the overall market was down was Cettire. And I'm pretty punching myself because it was fairly obvious the time to buy this company was around about the 14th or 15th of June. Share price got to $1.90, hit this long-term trend, went into this green area. I sort of described this green area as sort of the buy zone. That's the time when you want to think about buying the company. And then it just took off and has got to a new high, got through a resistance level. I don't know why the share price has taken off the last few days. Really good volume over the last month as well. So we're seeing increasing volume, which is telling me the fund managers are becoming interested in this company. And that's the sort of people you want interested in a company you have in your portfolio or you're thinking of buying. You want fund managers to be buying a company, not selling a company, buying a company, because fund managers are the people, the institutions, organizations who drive the share prices higher or lower over time. A lot of times the heavy lifting is done. Initially, the heavy lifting is done by retail investors, and then you want the fund managers to become, or the institutional investors to become interested in the company. Possibly that's what's happening with Cettire right now. And if I was going to buy this company, it would be just a technical trade. On the flip side, we have Magnis. And it's just fallen through a resistance level. That resistance level goes all the way back to 2020. And the reason, if we go back to 2020, that was the lows we saw. So we saw the breakout in the company share price in July. You can see beautiful shift in sentiment and trend in the share price. And we saw this, exponential rise in share price during July. Share price went from, 7.5 cents up to 25 cents. And what you want to see after that sort of exponential rise is no significant decrease in share price. Share price then just drifted down for about 5 months, got to a low on this day, the 19th of January 2021, and you can see a bounce on that day. And that bounce was the lows. And then we saw massive volume coming in. Must have been some good news. The share price went into an uptrend. And the top of the uptrend was back in November 2021. Share price reached 75 cents after another exponential rise. And then we did see a drop. And then share price got very close to that resistance level or support level in June 2022. Got very, very close, within a cent or so. And then that's the first resistance level. The reason that's a resistance or support level was because that was the lows back in June 2021. And then the share price fell through that initial support level on strength on 27th, 28th, or 28th, 9th of March. Right here, it tested it the next 4 or 5 days, and it really couldn't stay above that new now resistance level. Was support, now resistance level, and then it tumbled all the way down to the next support level, and it fell through that support level fairly easily. You can see on the 1st of June, if you can just zoom in, it tested it, and then we did see a little bit of bounce, but a very weak bounce. A bit of buying on the next day, but fairly weak reaction after the bounce off that support level. So again, technical analysis works. So you can draw in support resistance levels from old highs, old lows, and you will see the market test these levels time and time again. Because the market, when I say market, I'm talking about people. People know what the share price was back then. They know that was the lows back then, and they see the share price get to that point and think, wow, share price is back to that levels that it was back in 2020. I'm going to take a position in this company right now. And if you don't see a lot of those investors, you need strength. So you need a lot of those investors to be sort of a similar mindset. And then you need the day traders to come in who see a bounce and think, oh, wow, this is great. But it's tested that once, like a month ago, 3 weeks ago, and in the last few days has fallen through that support level. It might become resistance now, but I need to see it stay below that level for the next few days. So share price of Magnis now 13.5 cents. And it's really fallen a lot since the 21st of February. That was an interesting trading day. You could see that candlestick And that was the day they announced some sort of partnership or something with, was it Tesla? And the market, on the day, the share price opened up something like 20% higher, and then finished lower, almost lower for the day. And the share price has just tumbled ever since then. Anyway, another bad news story is DGL. So this was a company I was thinking about buying back in February to March last year. You can just see, did look like the trend was trying to change. And then the sentiment just started to shift violently in early April. You can see 3 big down days, in fact, 4 big down days in a row. And that was a sign that there was some sort of problems here. The market was a little bit wary, and the share price moved into a downtrend. There was a bit of a support level at around about $1.29.30. See, the share price just went sideways for about 2 weeks, right on that level, or that zone, if you want to call it, and then fell through. And then the company released a bad trading update or whatever it was, and share price has continued to fall on massive volume. On that day, they released that negative announcement, that trading update. You could have sold at $1. And when I do see that sort of announcement, when a company I do own, I typically do sell. And you could have sold out $1. Right now, the share price is 66 cents, 33% lower than what you could have sold out at $1. And there's absolutely no support for this company, no buying at all. And one of the reasons there's no buying is because if you go through history for this company, the share price has never been this low. So this is an all-time low for the company, which means there's no investors out there who go back through history and go, well, the share price was this low back in 2020. Well, I'm going to buy some share. There's no precedence. The share price has never been this low. So it's the same thing when the share price gets to a new high. There's no one saying, well, the share price was this price many years ago. I'm going to sell out or something like that. So that's why one of the reasons why share price keeps on falling. Markup $188 million. So last year, $369 million of revenue, $28 million of profit. So just imagine if they can maintain that profit, which is a crazy assumption, stupid assumption if you call it that. This company is trading on a PE ratio of 6.5. So I would put this company into my turnaround watch list. In fact, I might do that right now. I have a turnaround watch list. Turnaround watch list because this is sort of story of a company that I could definitely see turning around, and the market is completely overreacting. But the problem is I just don't know how more share price has to fall. It could fall significantly further because this is a very bearish chart, particularly what we've seen over the last 6 or 7 trading days. Now to QHL, Quickstep Holdings, markup $17 million. This company has had a lot of revenue, but they exist on very low margins. So they build stuff. That's all I can say. Build stuff. Composite solutions to the aerospace, defense, automotive, and other advanced manufacturing sectors. Manufactures complex composite parts and assemblies for build to print, blah, blah, blah. And they do build a lot of stuff, but very low margins. So for last year, $87 million of revenue, very little profit, less than $1 million of profit. Same thing the previous year, $85 million of revenue, profitless. And then in 2020, $82 million of revenue, $3.9 million of profit. The main reason I've included Quickstep in this video is just the volume we have seen in the past few weeks. We have seen really large volume compared to what we've seen over the past year. Very low volume, and then all of a sudden, massive volume. This could be a sign the bottom has been reached for Quickstep, and there are participants in the market who thinks there's value in this company now. And if we take a look at the long-term chart, the share price of this company has never been this low. So that is a problem. But I did say the market cap of this company, 17 million. I was like, whoa, yeah. And then I saw the volume went, oh. So I'll put this onto my watch list again, my turnaround watch list. This company's in my Appendix 4C watch list. That's it. They don't even do Appendix 4C. I'm not even sure what's on that watch list. Santos. Keeping a close eye on Santos, not the weekly chart, just the daily chart, because it did look like trying to move into an uptrend. And then we had a big down day on the Friday, down 4.33%. But it's moved into my little green area, which is my buying zone. The last time we saw it move into the green area, back on the 9th, 14th, and 15th of June, we did see a nice little bounce. But This is a company I've owned in the past, just a trading possibility. What you could do is you put a line sort of here, somewhere around there, sort of a zone area. That's if I did see the share price move to that point, maybe that's a buy. But this is sort of also a play on oil and gas. Yeah, not many opinions on Santos right now. The only thing is that was a pretty bad day on the Friday, down 4.3%. It could be just because the overall market. Ramsay Healthcare, company I have owned in the past, but the share price of this company has gone sideways for many, many years, since 2015. After what a beautiful uptrend, beautiful. This company was wonderful to own between 2011 and 2016-17, and then I reluctantly sold out, and then really has done nothing. And remember, there was a takeover bid for this company in April last year, I think. That's why the share price went to $84. Share price dropped all the way down to $56 after that takeover bid was failed or something. That was in September last year. Share price got to about $56, and we saw a nice little bounce. I was thinking about taking position back then, and then I didn't. And the share price has fallen through that low on Friday after 3 big down days in a row. Share price has moved into a downtrend. So this is an ugly looking chart for Ramsay, and the share price right now is at a long-term low. Last time share price was this low, it was during the COVID-19 financial panic on the rebound. So things are not moving in the right direction for Ramsay Healthcare's share price. Even their business is not really moving forward. I did see here some bullish forecasts for this company, because during COVID-19 and subsequent years, all those people who needed some sort of non-emergency surgery did put it off, and now Ramsay Healthcare is going to benefit from that. But based off what's been happening just on the chart, I don't think the market is convinced that's a tailwind for this company moving forward. Now, a company I did take a little position in is Fineos Corporation. I will be doing a video on this company, and this is just a technical trade. And we did see a nice little bounce on the 16th of June. That's why I took a position. Really good bounce, pretty good volume. And the share price in subsequent days has done really well, has held up really well, even though the overall market has sold off. My only concern was the share price did get to these levels back in January, February of this year, and then we saw a massive sell-off. If we didn't see the share price get to this level back in January, February, I'd be way more confident that share price of this company is moving to an uptrend. So what I'm going to do here is just put a line, say right here. If we do see the share price move above $2.30, sort of like the old high, that will be a very bullish move. So that's what I'm looking forward to. And if we see a really good week on the XJO, on the Australian markets, there is potential Fineos Corporation will do that. This company is moving towards profitability, but in saying that, they have a market cap of $700 million. A really good revenue, almost $200 million of revenue, but not profitable. And I think this is one of those companies, if they can show the market they will achieve profitability and can maintain profitability, I think even a market cap of $700 million is fairly low, because I think this company, with the growth this company will experience, I think this company can be highly profitable in another 5 to 10 years. A company I really like is PWR Holdings, and it's right at a support level. The old lows we saw back in September. Ooh, this is interesting. The share price is in a downtrend. We did see a bit of a sell-off in February upon the release of their results. That was a significant overreaction from the market. However, and one of the reasons it was an overreaction from the market is because the valuation of this company, a PE ratio is at 40 right now, is high. And the reason it's high is because of the potential of this company moving forward. Now, I am a shareholder of this company. If I saw the share price get down to, say, $5, less than $6, we'll say, the sort of the zone we saw back in June, I will be adding to my position. I might even add to my position right now, but I think there is possibility of more to $4. But if I do see the share price get down to $6, I will be taking an extra position or adding to my position in this company. So this is a long-term hold for me. I will not be selling my shares in this company at all. I don't care about the trend. The only reason I will sell my position in this company is if I see a change in my reasons for buying or initially buying into this company. So I need a change in my philosophy, change in my reasoning, something like that. Not this is a high quality company. a trend in the share price means nothing to me. But if I see value, that's when I add to my position. And even if a company is overvalued, in my opinion, I think PWR Holdings, when it got to about $12, was overvalued. I won't sell my shares then, because a company can remain being overvalued forever. Anyway, Myer, very bullish, extremely bullish chart from August all the way through to March. Remember, they released the results, and when they released the results, must have been on 9th of March, share price rose 18% on the day. That was a high. Share price has been taking ever since then. And a lot of times when I do see those sort of results, that sort of reaction from the market, I'd become interested, not for Myer. And I think the market was getting a little bit ahead of itself. And this is in that retail space. And I think the market is saying right now they don't expect Myer Holdings' performance, financial performance, to maintain moving forward. That's why the share price has dropped from $1.12 all the way down to 57 cents. Share price has halved. And not only that, the CEO's resigned. And I think the CEO has got out at the top. He's done his job. I think he was a brilliant CEO. And I think there are troubled times moving forward for Myer Holdings. JB Hi-Fi, one of the best quality companies on the ASX in terms of retail. Maybe not the highest. I'd say Levisa is the highest, but you have to pay for Levisa. JB Hi-Fi's price to earnings ratio 7.9, dividend yield 8.4, which means the market expects trouble for this company in terms of they expect profits to fall, which is understandable. But share price is holding pretty fine compared to a lot of other retail companies. And the main reason I've included JB Hi-Fi in this chart, in this video, is because the share price is right on a support level. And the reason that's a support level should be obvious. You can see back since December last year, we have seen the share price reach this level 1, 2, 3, 4, 5, 6, 7 times in the past. I would not be surprised to see the share price fall below this level and continue to fall. And I think there is potential the share price of this company will fall significantly further from here. And that would be a sign the market is overreacting. And there are a few interesting companies within retail right now that are based off just valuations, even if the profit halves. So if the profit for JB Hi-Fi halves, the price to earnings or the dividend or price to earnings ratio would only be 15, 16, which is not too high for this company because they are growing. This company is still growing over time. Now, more than likely, their growth will be impeded by a recession, slowdown in the economy, that sort of thing. But over the next 5 to 10 years, I expect this company to be significantly bigger than it is now. And if you do have that long-term mindset, this could be a company you might want to add into your portfolio. And I do own this company in my portfolio, my long-term portfolio. This is a company I bought way back in 2012 at $8. I didn't sold when its share price doubled. And when I bought in 2012, it was the most shorted stock on the company, of the ASX. And you'll hear a lot of people say, a lot of experts say, don't buy those companies that are the most shorted stock. Listen to the market. But the whole reason JB Hi-Fi was the most shorted stock back then was because of the threat of Amazon. So that was over 10 years ago. And even though Amazon is now here and is a presence, and I use Amazon all the time, Amazon Prime, JB Hi-Fi has not been affected by Amazon. We can have Amazon and JB Hi-Fi perform very well financially in Australia at the same time. And I think JB Hi-Fi has proven that. I've also told the stories of me going into JB Hi-Fi versus Dick Smith, and it was night and day difference between the two companies. And that's one of the reasons I'm so bullish on JB Hi-Fi is just the management and what they do with their stores. Also, apparently one of the most highest profit margin stores or something like that in the world. Maybe that's Levisa. Now, another company, McPhersons Limited. So this company has had a roller coaster ride over the past 6 years. So 2015, we saw the share price get to a really, actually over the last 10 years, look at that roller coaster ride. Share price got to about $3.50 way back in 2011 and fell all the way down to 50 cents. And then it went from 50 cents all the way back up to $3.50, and then has fallen from $3.50 all the way back down to 50 cents. Actually, in fact, it's fallen below 50 cents. I suppose the only reason I've included this company in this video is because the share price has fallen through that lows we saw back in 2015 at 50 cents, and it fell without any resistance whatsoever. You could say, there's a little bit of buying, the days before it fell through, but as soon as it fell through, it just dropped. 50 cents down to 45 cents, which might not seem a lot, but that's a 10% drop from the support level. So market cap of this company is 65 million. Now, one of the reasons I probably wouldn't be interested in this company is just the revenue has gone sideways, not growth in revenue. Company has been profitable in the past, so $13.7 million of profit in 2019, $6 million in 2020, small profit in last year. If this company can start growing a little bit and remain profitable, this could be cheap. But the question is, can the company achieve that? Premier Investments. So unlike JB Hi-Fi, the company share price of this company has just dropped like a rock. PE ratio 10.7, dividend yield 6.3. So I can definitely say that the market was getting a little bit too bullish about this company back at the start of the year. Share price got to $28. Now it's $19.62. So the share price has dropped about 40% since those highs. Wasn't a nice uptrend, but I ignored most of the companies, or most of the retail companies who were in nice uptrends. And the share price has just fallen off a cliff, fairly similar to XM Group. Lovisa has fallen off a cliff. I do own Lovisa. I don't own Premier Investments. I have owned this company in the past. I am bullish. If they can or could separate Smiggle and Peter Alexander and then sell off the rest, I'd probably be even more bullish about this company. I sort of wish they would do that, because in my opinion, this is a two-store company, Smiggle and Peter Alexander. Also heard someone say that Smiggle may not be as defensive as what you think, because they sell like bags for kids, those sort of things that teach your parents now, if they're definitely under financial stress, won't go to Smiggle and pay ridiculous amounts of money for kids apparel, kids bags, that sort of thing. And more than likely, they'll go for the cheaper option they can find Kmart or something like that. I'm not sure the kids will like that, but if the parents are under financial stress, that might happen. And the reason I put this in this video is the share price is starting to test the old highs we saw back in June last year. So still a long way to fall before we see the share price fall to the COVID-19 lows, which was just above $8. But the other thing is the share price is now lower than pre-COVID. So if you just take the viewpoint that the share price of this company or valuation is lower than pre-COVID, and that was 3.5 years ago, this company might be undervalued. And I probably could, I could buy that. I'd probably become interested in this company if it fell to maybe 13, 12. If I saw this company for, let's say, less than $10, I definitely would take a position. So as it falls and falls and falls further from here, I would become more and more interested. But the question is, how much further has the share price to fall? What you could do is take a small position and then add. People say don't do this. Add to a losing position. But if you think a company is high quality and will be high quality for many, many years to come, take an initial position, and if the share price falls significantly further, just add to a position, and then you actually significantly decrease your buying price. So if you buy at, say, $20, 1,000 shares at $20, say, and the share price falls to $10, you can buy 2,000 shares, and then your overall average would be like $13, not $15. I've done that in the past, and it has been a very successful strategy, but it only works with high quality companies. Whether City Chic is a high quality company remains to be seen. Not sure why I'm including this company. Oh, I know. I remember why. Okay. So the share price has dropped from almost $7 down to 31 cents. At $7 or just shy of $7 in September 2021, the market cap of this company was $1.5 billion. And even then, there was a lot of chatter about this company. A lot of interested fund managers about City Chic. What a great company, high quality company. Well, things have really turned sour for this company. And the markup of City Chic right now is $74 million, which means those fund managers who were very high on this company back in September 2021 probably could buy the whole company right now for $74 million. Now, one of the things I'm going to do with this company is just wait. just wait, because they have not released very good reporting or trading updates. But I'm just going to wait, because this could be a fairly similar turnaround story to Temple and Webster. Now, I've not included Temple and Webster in this video, but let's have a look at Temple and Webster back in. This is, I don't have regrets, but this is one of my biggest regrets. So Temple and Webster listed on the ASX back in late 2015. Share price dropped from about $1 all the way down to less than 15 cents. And then there was a breakout in the share price in July 2017. Just after that, I went on a long holiday and I wasn't really paying attention to the markets. And that was from July through to November. And the share price actually did increase a fair bit. So I thought I lost my opportunity. And I still remember thinking back then when the share price was going sideways here, I think the low has been reached, but there was a lot of, would this sort of business model work? Selling furniture online, will it work? And I did have my doubts. And then look what happened to the share price. This is before COVID-19. So this was one of my big, and I really wasn't as much into technical analysis then as I am now. And this was a screaming buy anywhere from, say September 2017 all the way through to 2019. Share price was in a beautiful uptrend, even a little bit of a dip during COVID-19. Right now, this is on my watch list because possibly we are seeing a bit of a turnaround in Temple Webster, market cap 620 million. But this City Chic sort of reminds me of Temple Webster way back in 2017. Possible turnaround story, just possible at this point in time. There's a saying that turnarounds don't turn around or seldom turn around. I don't believe that at all. Although some people have also said that when Warren Buffett said that, turnarounds seldom turn, he's not talking about these sort of turnaround stories. He's talking about those mature companies who have been big for a long time and then have fallen out of favor and have seen decreasing revenue for years and years and years. Those don't turn around or very seldom turn around. He's not talking about Temple and Webster. He's not talking about City Chic. And I agree. We do see those big mature companies, eventually they'll just go by the wayside. Anyway, KMD Brands, I always think of this as Kathmandu, released a fairly good results in May. Share price looked like it was going to break out of this top of the trading range, but because of the pressure in retail sector, share price has dropped a lot, and it's dropped all the way back down to 91 cents. And the reason I've included Kathmandu or KMD in this video is because that's at a support level. Right on the support level. We'll see what happens with KMD Brands over the next few days if that support level holds, but maybe a potential low risk buy. So you buy in KMD Brands at about 91, 92 cents and hope for a bounce. And the share price falls to say 90, 89 cents or something, you just sell because your play has failed. I did include Temple Webster in this video, and I thought I didn't. Well, I don't have to talk about Temple Webster because I've already talked about it. And the last company is Cettire. This is a low-quality company on the ASX. But look at the chart we have seen and the price action we have seen in the past 3 weeks. Broken through a resistance level on strength. And when I say on strength, I want high volume and a really good one-day candlestick. And this is a sort of one-day candlestick you want to see. Share price on this day increased 8.7% on high volume. Highest volume we have seen for a long time, or equal highest volume we have seen for a long time. And then after that, share price didn't test the breakout point, which was around about 71.5 cents. Share price went sideways over 3 days, which means there's no selling, and the share price has continued in its uptrend. Not only that, when the overall market was down a lot the last few days, Service Stream was up. In fact, on the Friday, it was up 2.6%. Last time share price was this high was way back in August last year when there was bad news. They must have released some bad results because that's in August. Share price dropped 17.2%. So it looks like for some reason the market likes Service Stream right now. So this is a possible trading opportunity, and I did take position in Service Stream. Anyway, and again, I don't think this is a high quality company. This is not a long-term hold for me. This is just a trend. This is just a trading Just a trade for me, just because of the chart and the price action, volume, share price action, volume, and what's happened in the last few days. In fact, I bought previous to that, but it's okay. I bought because of this. Yeah. Now, if you have any questions about any company I've featured in today's video, I'd love to hear your questions, your thoughts. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.